You're back with Today with me, Xu Qingduo, and Ben Liang. With today's business stories, here's Zhao Yang.
Well, thank you, Qingduo. And let's check out some of the key events on the corporate front here in China this week. Join me on the line is Jeffrey Towson, Professor of Investment at Peking University Guanghua School of Management. So first, this week we saw Beijing-based hospital chain United Family Healthcare agreed to be purchased after a bidding war erupted between some of the China's leading private equity firms. The winning bid of a little bit more than 460 million US dollars came from Fosun and TPG. So we know that United Family is one of the oldest private hospital groups here in China. It was opened in 1997 by Robert Lipson and is most notable for being mostly foreign-owned, and is also known as the place where many celebrities go to in Beijing. But they traditionally served expatriate patients, but are now about 50-50 expatriates and Chinese. So Professor Towson, this is also one of the Beijing's most well-known hospitals publicly traded in New York. So was this bidding war surprising for you? And why such interest in Chinese hospitals, especially by groups such as Fosun and TPG?
It is somewhat surprising. It was pretty cool to watch, actually. United is a very well-known group, but it's actually relatively small. You're talking about 200 to 300 hospital beds total, which is quite small, especially for such, big famous groups to be bidding against it. So I think this is really about getting into Chinese hospitals for investors. And there simply aren't that many companies you can buy out there right now. So even though it's a relatively small group today, it is a potential way to grow into the future. So this was sort of a way to get into that. I think that's why there was the interest, was it maybe reflects that lack of opportunity to get in if you really believe in the growth of this space.
But is Chinese healthcare a growth industry? Certainly, the government has made modernizing the healthcare system a priority in the past several years. But do we expect private hospitals to become more widely used here in China?
Right. I mean, the model people are thinking about is if you look at India, you look at Turkey, you look at maybe the Middle East, other groups that have started to build private hospitals, the numbers are pretty impressive. A group like Fortis, which is in India, started in 2001, just a couple of years after United Family. They've got 12,000 hospital beds across 75 hospitals today. So those are the kind of numbers people are thinking about when they think about, can Chinese healthcare be something like that? And you can find similar examples in other countries. So you can look at this one of two ways. You can either say, hey, this is a phenomenal growth opportunity that whoever gets into Chinese hospitals, hundreds of hospitals. Or you could turn it around and say, look, why hasn't it happened? Happened in other countries. Why aren't we seeing it here? And has that changed? Are we still in that maybe stuck situation? And I tend to fall on the former. I think hospitals are growing fairly quickly right now, and that's a pretty good change from the last couple of years.
And also another story in the past week, China's state media regulator says it will revoke Sina's license to publish newspapers, magazines, books, audio and video online as punishment for lewd content on its sites. It has also said it's imposing a large number of fines and initiating criminal investigations. So this news followed just 2 weeks after Sina Weibo had a somewhat difficult IPO in the U.S. So, Professor Towson, how serious is all this for Sina? Does the license revocation have a big impact on their business?
I mean, this announcement came out, and I think it was a little bit shocking, especially for Sina. But the site appears to be functioning. And it was supposed to rely on the video streaming. Sina makes money advertising off news, entertainment, and video in other places. So it's not a huge portion of their business. But we haven't really seen that release. Not that I remember of when they have these maybe crackdowns on sort of this type of, content, lewd content, you'll see blockages, but you won't see the license of the site pulled. So that got people's attention. But, as far as I can tell, the site's still working, and, there's a quick apology made, and, so it's unclear that this is more than just sort of a warning to them.
And also talking about Sina Weibo's IPO in the U.S., what happened to that? They filed to raise $500 million on the Nasdaq, and valuations of $5 to $7 billion were discussed. But the IPO finally ended up raising only about $290 million. So, Jeffrey Towson, so is it a undersubscribed, and they even couldn't find enough buyers for the shares, so they just dropped the price right before the IPO. Is that the case?
Yeah, there were some announcements made, really the day of the IPO, the day before, a couple of days before, that, there weren't enough people that were signed up to buy shares. This is for Weibo Corp, not Sina. It's a subgroup. So they had to, basically drop the price. Now, when it went public, the shares did go up about 20+% that day, which is nice. But clearly not the kind of day that everyone was hoping for. People have argued about what's going on with this, and I think there's a lot of factors. It could be a little bit regulatory. It could be, that it's not making money, this subgroup Weibo, yet. I tend to think this has a lot to do with WeChat. The Weibo story, which was so amazing 2-3 years ago. Now the question is, how do you compete with WeChat, which everybody I know is using? So that probably was part of it.
And another story, Alibaba and Yunfeng Capital have bought $1.2 billion worth of Chinese online video service Youku Tudou. The deal gives Alibaba a 16.5% stake in one of the largest online video platforms, and Yunfeng holds 2%. So we know that Yunfeng Capital, which was the minority partner in this deal, is the investment group of Jack Ma. So is this similar to other Alibaba deals we have been seeing over the past weeks, and what is the rationale for this fairly large acquisition?
Right. We've seen this is coming out every week. Alibaba, Tencent, Baidu, they're just buying companies like crazy. It's pretty amazing to watch. And they're in a couple sectors, e-commerce, location services. This would be more in just sort of the media space. We saw Alibaba buy part of China Vision Media, which is another media company, just a couple weeks ago. Tencent bought CJ Games, the Korean gamer, just a couple weeks ago. So it's just going on and on. These companies are just rapidly acquiring and expanding their businesses. It's pretty amazing to watch this.
And final story, Disney has just announced that they and their partners are investing another $800 million into the Shanghai Disneyland and construction. That will bring the total projected spending of this Disneyland to $5.5 billion, with the park set to finally open next year. So last question, Professor Towson, is this going to be a success? Is China's mainland ready for a full Disneyland?
Right. I'm bullish, and the number I always remember is two numbers. Is the largest Disneyland in the world is right now in Florida, and they have about 50 or 60 million visitors per year. The Shanghai Expo, which happened just a couple years ago, they had 70 to 80 million visitors in 6 months. So I tend to think this is, going to be very successful one way or the other.
And $5.5 billion, is this a huge Disneyland or is just a proper?
It's not a huge one. Definitely it's not as big as, say, Euro Disney Paris. It's not as big as the huge one in Florida. So it's sort of medium to, a little bit smaller size. And it's part of a development out there in Pudong where there is a larger piece of land about the same size still available right next to it, with the idea that this or another park is going to grow.
Well, thank you, Jeffrey Towson, Professor of Investment at Peking University, Guanghua School of Management.
I wonder how the one in Hong Kong is doing as well in Disneyland there.
Competition.
It's smaller than the Shanghai one.
Do you
Then
need
there will be a fewer number for Chinese mainland visitors, so fewer problems.
Yeah. Well, what about the one in Japan? The first one in Asia there.
Well,
Too many
competition
of-
is good for market.
No, too many of these anyway. And Euro Disney is terrible. Thank you, Zhao Yang and Jeffrey.